Okay, let's dive into this. Financial statements.
Hmm.
When most of us think about them, we probably picture, you know, big public companies.
Yeah, the ones listed on the stock exchange,
Yeah,
complex reports.
exactly. But that's really just like one part of the whole picture. What about that huge world of entities that aren't companies or LLPs?
And it really is huge. We're talking everything from, a sole trader running a local shop
Right.
to maybe large trusts, partnership firms, societies, HUFs, even some statutory bodies. It's a massive group.
And they're often grouped under this term, non-corporate entities.
NCEs.
That's the one, NCEs. And for anyone involved with them, running one, investing, lending, figuring out their financial reporting can be, well, a bit tricky.
Because I guess traditionally it hasn't been quite as standardized as the corporate world.
Precisely. And that's the challenge we're really digging into today, how that reporting landscape is getting more structured for these NCEs,
Yeah.
specifically in India. Okay. And our main source for this deep dive, our guide, is a key document from the ICAI, the Institute of Chartered Accountants of India.
Yep. It's their guidance note on financial statements of non-corporate entities. Came out in August 2023, so pretty recent.
And this is basically the ICAI's official take on how these NCEs should prep their financials.
Exactly. It's authoritative guidance.
So think of this as your shortcut, your deep dive into understanding who this guidance actually applies to, what a full set of financial statements looks like for them now, and maybe most importantly, why this matters, bringing some clarity to NCE reporting.
Sounds good. So let's start right there. Who exactly are we talking about? What is an NCE according to this guidance note?
Okay, so the source defines them as business or professional entities other than companies under the Companies Act and other than limited liability partnerships, LLPs.
Right. So it's defined by what it isn't, in a way.
Yeah. And the list of what is included is honestly pretty staggering. It's a real mix. You've got your sole proprietorships, Hindu undivided families, HUFs,
Huh.
partnership firms, whether they're registered or not.
Okay, the common ones.
Then it gets broader. Associations of persons, or AOPs. That could include other types of firms, body of individuals, resident welfare associations.
Wow, okay. Resident welfare associations, too.
Yeah. Plus societies, trusts, private, public, registered or not. And this surprised me a bit. Statutory corporations, autonomous bodies, authorities.
So even some quite large, potentially government-related bodies fall under this NCE umbrella if they aren't specifically companies or LLPs.
Seems like it. Basically, the source says if you're an organization in India doing business or professional activities, even just partly, and you're not a company or LLP, this guidance is likely aimed at you.
That sheer variety really highlights the challenge, doesn't it? How do you make standard rules for such different setup?
Exactly. Which leads to the next question. Why the push for this standardization now? What's the driver?
Well, the guidance note itself makes a pretty strong case. It argues that a sound financial reporting system is just fundamental for, economic development. It builds trust.
Trust with who?
Think about stakeholders. Lenders considering a loan, potential partners or investors, people donating to a trust. They all need reliable info to make good decisions.
Right. And NCEs, even the smaller ones, have loads of stakeholders, don't they? Employees, suppliers, customers.
Absolutely. And the note also points out that some NCEs, especially maybe those statutory corporations we mentioned, actually raise quite a bit of money from the markets.
Like a company would.
Kind of. So their users have very similar needs for high-quality, reliable financial data. Plus, just generally, the economic footprint of NCEs has grown. Think government initiatives, public-private partnerships. They're more significant players.
So better reporting makes their financials more reliable, complete, and comparable.
That's the goal. Comparability is key.
Okay, that makes sense. Economic importance, stakeholder needs. So how do accounting standards AS fit into this? Do all these different NCEs just follow one set of rules?
The basic principle is that accounting standards apply to any entity doing commercial, industrial, or business activities, even if it's just part of what they do.
Right.
In India, for entities that aren't companies, the ICAI prescribes the relevant accounting standards. This guidance note we're discussing, it sort of builds on that. It focuses on how those AS apply and, importantly, how the financial statements should actually be presented.
And I remember reading the ICAI doesn't just lump all non-company entities together for AS compliance. There are different levels, right?
Correct. And that's crucial for managing that diversity we talked about. They classify non-company entities into 4 levels.
Okay.
Level I are the large entities, level 2 are medium, level 3 small, and level 4 are the micro ones.
And levels 2, 3, and 4 together are sometimes called
MSMEs. micro, small, and medium-sized entities.
Got it. And what decides if you're level I or, say, level 4? Is it just size?
It's based on a few factors, detailed in the guidance appendix. Things like, are they listed? What type of entity are they? Like banking or insurance have specific rules. And yes, turnover and borrowings are key criteria.
So the specific rupee amounts matter there.
They do. But the main point for now is that level I entities, the big ones, they have to comply fully with all the applicable accounting standards. No breaks.
Okay. But the MSMEs, which I imagine is the vast majority of these NCEs,
That's a fair assumption.
they get some relief, some relaxations.
Yes, absolutely. The SMA recognizes it can be tough for smaller outfits to handle the full weight of all AS requirements. So at levels 2, 3, and 4, the MSMEs get specific exemptions and relaxations from certain parts of the standards. It's about finding that balance between good reporting and practical feasibility.
Okay, so this specific guidance note, the one from August 2023, it updates an older version.
Yes, it supersedes a previous technical guide from 2022.
And its job is to give that official, authoritative guidance and standard formats.
Precisely. Standard formats are a big part of it. The aim is enhancing quality, making things comparable, making them more comprehensive.
And it's live now, basically, effective from April 1st, 2024.
For financial periods starting on or after that date, yes. So very relevant right now.
Okay, great. So we know who's covered, why it's important, the role of AS in these levels. Let's get into the building blocks. What actually makes up a complete set of financial statements for an NCE under this guidance? What are the essential pieces?
Okay, the guidance lists the core components pretty clearly. First up, you need a balance sheet.
The snapshot in time, financial position,
Exactly. Then a statement of profit and loss.
or income statement, P&L, shows performance over the year.
Right. Income versus expenses. Then a cash flow statement. But there's a catch.
Oh, what's the catch?
It's only required where applicable, which, as we'll see, means it's actually not mandatory for many of the smaller NCEs, the MSMEs.
Ah, okay. So balance sheet, P&L, maybe cash flow. What else is considered part of the complete set?
This is critical. The notes to the financial statements, plus any other related statements or explanations. The guidance is really strong on this. These notes are an integral part.
Not just optional appendices.
Definitely not. They're fundamental. This includes disclosing your significant accounting policies, too.
Why are the notes so vital? What do they add?
Well, think of the main statements, balance sheet, P&L as the headlines.
Okay.
The notes provide the story behind the headlines, the breakdowns, the extra detail, information on things that aren't even on the face of the statements, like contingent liabilities, potential obligations.
That might happen.
Exactly. So the notes are essential for anyone trying to get a full and, fair understanding. The guidance also stresses that they need to be properly cross-referenced back to the main statements.
So the whole package statements plus notes is designed to give users this comprehensive view. Position, performance, cash flows.
That's the objective. To provide information that's useful for assessing things like, can the entity generate cash? What's its financial structure like? Is it liquid? Is it solvent? How well can it adapt to changes? Basically, understanding its past and assessing its future potential.
Makes sense. Okay, let's drill down a bit more into the specifics of the balance sheet and the P&L. What are the key requirements for the balance sheet presentation?
Okay, the balance sheet, remember, snapshot on a date. The prescribed formats generally show owner's funds and liabilities on one side.
And assets on the other. Standard accounting equation stuff.
Pretty much. And owner's funds is the term they use for what you might call equity in a company context.
Got it. Residual interest.
Exactly. The source links back to the basic framework definitions. Asset resource controlled, future benefits expected, liability present obligation, outflow expected, equity or owner's funds, the residual.
Now, a really important classification on the balance sheet is current versus non-current, right?
Yes, absolutely critical. The guidance mandates this split. An asset is current if it's likely to be realized or used up within the normal operating cycle.
What's the operating cycle again?
It's the time it takes to, say, acquire materials, process them, sell the product, and collect the cash.
Right.
Or if it's held mainly for trading, expected to be realized within 12 months of the reporting date, or it's cash that's not restricted for at least 12 months, everything else, non-current.
And if there's no obvious operating cycle?
Then the default is 12 months.
Okay. And liabilities, same logic.
Similar logic, yes. A liability is current if it's expected to be settled in the operating cycle, held for trading, due within 12 months, or crucially, if the entity doesn't have an unconditional right to put off settling it for at least 12 months after the reporting date. All other liabilities are non-current.
That distinction seems really important for figuring out short-term financial health.
It is. It's key for assessing liquidity.
The guidance also flags trade receivables and trade payables specifically.
Yes, just defining them clearly. Receivables are what's owed to the entity from customers for goods or services in the normal course of business. Payables are what the entity owes to its suppliers for the same reason. Standard stuff, but defined.
Okay. Now, you said the notes are integral. This must be where a lot of the standardization detail really comes in for the balance sheet items.
Oh, absolutely. The general instructions section of the guidance goes into a lot of detail about what needs to be in the notes. This is where you see the structure being enforced.
Like what? Give me some examples.
Okay, for owners' funds, a big one for NCEs, like partnerships. You need a detailed reconciliation showing all the movements during the year for each individual owner's capital or current account.
Each owner separately. Wow.
Yep. Opening balance, any new capital they put in, any salary or remuneration paid to them, interest on their capital, drawings they took out, and their allocated share of the profit or loss for the year. It's granular.
That really highlights the close link between the owners and the entity in these structures, doesn't it? Different from shareholders in a big company.
It really does.
Yeah.
Then take borrowings. The notes need to break them down by type term loans, deferred payments, loans from related parties, lease liabilities, others.
And secured versus unsecured.
Yes. Specify secured or unsecured, and if secured, what's the security? Also, disclose if owners have personally guaranteed any loans. Repayment terms are needed too, including highlighting the portion that's due within the next 12 months, the current maturities.
Okay. And you mentioned something earlier about a specific rule for trade payables linked to regulations.
Yes, this is a really important one in the Indian context, tied to the MSME Act, the law supporting micro, small, and medium enterprises.
Thanks to disclosure.
The notes must give detailed information about amounts owed to suppliers who are registered MSMEs. And it's not just the principal amount owed. You have to disclose any interest due because of delayed payment, the amount of interest actually paid during the year on those delays, the interest due and payable at year-end specifically for those delays, any interest accrued but not yet due, and get this, even the further interest that's still accumulating until the payment is finally made.
Wow, that's incredibly specific. It directly links government policy on supporting MSMEs to what NCEs have to report.
Exactly. It's a great example of how financial reporting reflects the broader regulatory environment.
Okay, what about the asset side? Fixed assets, for instance. Property, plant and equipment, intangibles.
Similar level of detail required in the notes. You need classifications, break down PPE into land, buildings, plant, machinery, etc., intangibles into software, licenses, brands, whatever applies.
And track changes.
Yes, a reconciliation is mandatory for each class of asset. It needs to show the opening balance, any additions during the year, any disposals, the depreciation or amortization charge, any significant changes due to revaluation, and any impairment losses recognized.
So you can clearly see how the value of those assets has moved over the period.
Precisely. Transparency on asset movements. Investments also need detailed notes.
How so?
Classification: are they trade investments needed for the business or other investments? What specific types? Equity shares, debt instruments, mutual funds, even investments in other partnership firms.
Investing in another partnership. Interesting.
Yeah, and for those, there's a special format required in the notes. You need to list the names of the partners in their other firm, its total capital, and the NCE's share in it.
Very NCE specific again.
Right. Plus, for all investments, you need to list the entities invested in, distinguish between quoted, market value available, and unquoted investments, and disclose any provision made if the value has dropped significantly.
It really feels like the notes are where the substance is building out from the summary numbers on the balance sheet face.
They absolutely are. You can't understand the statements without them.
Okay, let's shift to the statement of profit and loss, the P&L. What are the key presentation and disclosure points there?
So, the P&L shows performance over the period, matches income against expenses to get the profit or loss. Income means increases in economic benefits that boost owners' funds, but not from owner contributions. Expenses are decreases that reduce owners' funds, but not distributions to owners. Basic concepts.
And how does the guidance want revenue presented?
It requires a breakdown of revenue from operations. Typically things like sale of products, sale of services, other operating revenues. Finance entities have a slightly different tailored format, focusing more on interest income, fee income, etc.
Makes sense. And on the expense side, any specific classifications needed?
Yes, finance costs need careful classification. You'd show interest expense separately, but excluding any interest paid on the owner's own capital.
Where does interest on owner's capital go?
That's shown as a separate line item, interest on partners' members' capital, another NCE-specific thing. Then you'd list other borrowing costs and any net gain or loss on foreign currency transactions related to borrowing.
Okay. And other income.
Things like interest income received from bank deposits, etc., dividend income, net gain or loss on selling investments, and any other income that isn't from the main operations that gets grouped under other income, often with a breakdown in the notes.
Now, is there a rule about disclosing specific expense items, even if they seem small?
Not regardless of amount, but there's a very important threshold rule.
Okay.
The guidance requires specific disclosure, either on the face of the P&L or in the notes, for certain items like employee benefits expense. That needs to be broken down into salaries and wages, contributions to Provident and other funds, staff welfare expenses, etc.
Right.
And here's the key threshold. Any single item of income or expenditure that is more than 1% of the total revenue from operations or are 1 lakh rupees, or 1,000, whichever is higher, must be disclosed separately.
1 lakh. Okay, that's about, what, 1,000 pounds, $1,200. It's quite a low threshold, especially for smaller entities.
Yeah.
It means even moderately sized individual expenses could need separate disclosure.
Exactly. It forces transparency on items that might otherwise get buried in miscellaneous expenses. The source lists examples that often need detailing if they cross the threshold: rent, repairs to buildings, machinery, insurance, rates, and taxes.
So it prevents hiding significant costs.
That's the idea. And any exceptional or extraordinary items or things related to prior periods also need their own disclosure.
So again, the P&L gives the summary result, but the notes provide the crucial breakdown and highlight significant or unusual items.
Precisely.
Okay, we touched on the cash flow statement earlier, mentioning it's not always mandatory. Can you elaborate on that? Who gets exempted?
Right. So the cash flow statement is super useful, no doubt. It shows how cash moves through the business, from operations, investing activities, financing activities, helps assess liquidity, cash generation.
Right.
But for level 4, level 3, and level 2 MSMEs. So all the micro, small, and medium categories preparing one is not mandatory.
Wow, that's a pretty big relaxation for potentially the vast majority of NCEs.
It really is. It acknowledges the complexity and potential cost involved in preparing a full cash flow statement, especially for smaller entities. The guidance encourages them to do it if they can find it useful, but it's not a requirement.
And if they do prepare one, or if a level I entity prepares one?
Then it follows the standard format, classifying cash flows into those 3 buckets: operating activities, day-to-day business, investing activities, buying, selling long-term assets, investments, and financing activities, dealing with owner capital borrowings.
Okay, so the cash flow exemption is a major relaxation for MSMEs. What other specific breaks do they get from the full accounting standards under this guidance?
This is where that phrase, as relevant to their level, really comes into play. The ICAI has built in specific exemptions for MSMEs, levels 2, 3, 4, from certain requirements within the applicable accounting standards to ease the compliance burden. The appendices in the guidance note list these out standard by standard.
Can you give us a feel for the types of standards where they get these relaxations?
Sure. They often get relief from some of the more detailed disclosure requirements in several standards. For example, AS10 on property, plant and equipment, AS11 on foreign exchange effects, AS13 on investments, AS19 on leases, AS26 on intangible assets, AS29 on provisions and contingencies.
So they might have to apply the main accounting principles, but don't need to provide all the extensive footnote breakdowns that a big level I entity would.
That's often the case. It simplifies the note preparation significantly.
What about some of the really complex standards, like employee benefits or income taxes?
Good examples. AS15 on employee benefits has quite significant relaxations, particularly based on the number of employees. If an MSME has, say, fewer than 50 employees on average, they get major simplifications for accounting for things like pension plans or gratuity, defined benefit plans. They might be able to use simpler calculation methods instead of needing full, complex actuarial valuations using the projected unit credit method. And there are relaxations around discounting long-term liabilities, too.
That sounds like it could save a lot of cost and hassle, avoiding expensive actuarial reports for smaller businesses.
It definitely does. And then there's AS22, accounting for taxes on income. Here, level 4 entities, the smallest micro ones, get a huge break.
What's that?
They only need to account for current tax, the tax payable for the current year. They are completely exempt from accounting for deferred tax.
No deferred tax at all for level 4. That must simplify things massively.
Immensely. Deferred tax, which deals with the future tax effects of current transactions, can be really complex. Removing it for microentities is a major simplification.
Are there other standards that just don't apply to MSMEs?
Yes, some standards are generally not applicable unless specifically required or if the entity chooses to apply them. For instance, AS14 on amalgamations isn't usually relevant for level 4. Standards dealing with consolidated financial statements, AS21, AS23, AS27, or interim financial reporting, AS25, are typically not required for NCEs, especially MSMEs, as they usually don't have subsidiaries or issue interim reports.
Yeah.
And AS28 on imperative assets also has some relief. Level 2 and 3 entities can use simpler methods to estimate value in use instead of complex present value calculations. And again, certain disclosure paragraphs don't apply.
These exemptions really paint a picture of trying to make compliance proportionate to the size and complexity of the entity.
That's definitely the intention.
But if an MSME takes advantage of these relaxations, do they need to tell the readers of their financial statements?
Yes, absolutely. This is a key disclosure requirement in the guidance note. An MSME that uses these relaxations must state clearly in its notes. 1, that it is an MSME. 2, which level it falls into, 2, 3, or 4. And 3, that it has complied with the accounting standards as applicable to entities of its level.
So users know which set of rules is being followed.
Exactly. They also need to disclose if they chose not to take an exemption that was available to them, perhaps because they preferred to give more detail. It provides essential context.
That makes total sense. What happens if an entity grows or shrinks and moves between these levels? Do the rules change immediately?
There's a rule for that too, designed to prevent opportunistic switching. If an entity's size decreases, qualifying it for a lower level with more relaxations, it doesn't get those relaxations straight away.
Oh.
It needs to stay classified at that lower level for 2 consecutive years before it can apply the additional relaxations available at that level.
A stability mechanism. Prevents flipping back and forth just for easier reporting in 1 year.
Precisely. It ensures the classification reflects a more sustained change in size or status.
Okay, that seems sensible. So we've covered a lot of ground. Who NCEs are, why this structured reporting is needed, the components of the financial statements with those crucial notes, and the specific tailoring of AS application for MSMEs through levels and exemptions. Let's just zoom out for a moment. Why does getting into the weeds of this guidance note matter to you, the listener?
Well, if you're actually involved in running or advising any kind of non-corporate entity in India, a partnership, a trust, a society, a sole proprietorship, then this guidance note is essentially your rulebook now. It dictates how you need to prepare your financial statements to be compliant, transparent, and credible for banks, partners, regulators, everyone.
And what if you're on the other side? Someone using these NCE financials. Maybe a lender, a potential partner, someone looking at a charity's accounts.
For you, this standardization is huge. It means the information you're getting should be presented more consistently, making it easier to compare apples with apples, easier to understand the real financial position and performance. It should lead to better, more informed decisions.
Right. Makes analysis more reliable.
Hopefully, yes. And even if you're just generally interested in finance and accounting, this whole area is fascinating. It shows how core accounting principles get adapted for different legal structures, different sizes, different complexities, all while trying to achieve that fundamental goal of a true and fair view.
It really demonstrates that the need for clear, reliable financial information goes way beyond just the big listed companies. It permeates right down through the whole economy.
Absolutely. It affects organizations big and small that form a huge part of the economic landscape.
So just to recap our journey, we started by looking at this incredibly diverse universe of non-corporate entities, NCEs, and why there's a growing need for more standardized reporting for them.
Driven by their economic weight and stakeholder needs, yeah.
Then we broke down what constitutes a complete set of their financial statements, the balance sheet, P&L, cash flow sometimes, and those absolutely critical notes, highlighting specific details like owner account movements or the MSMED Act disclosures.
And we explored how the ICI manages this diversity through the 4-level classification system, providing practical relief for MSMEs via specific exemptions from accounting standards, while ensuring they disclose the basis of their reporting.
The big takeaway really is that this guidance note represents a major effort to bring more structure, quality, and comparability to financial reporting for this vast and vital segment of the Indian economy.
Definitely a significant development. And maybe here's a final thought to leave you with, something to chew on.
Go for it.
We've talked about the huge diversity covered by this single guidance note: tiny sole traders, complex trusts, partnerships, even large statutory bodies. Given that range and the different legal and operating realities they face, how effective can one primary set of formats and a tiered system of AS application realistically be in capturing the full, nuanced, true, and fair view for every single one of those different NCE types? Is standardization always the perfect answer across such a spectrum?
That's a great question. The classic tension between standardization for comparability and specificity for capturing unique realities. Something definitely worth thinking about. Perhaps, pick an NCE type you're familiar with or curious about, maybe a local club or society or a family business run as a partnership, and try to imagine how these specific formats and rules would apply to them. You might uncover some interesting nuances or challenges just by thinking it through.